Hi, this is Cindy Presgraves with Cindy's Realty Group, and I'm by EXP, and I want to talk to you about why you shouldn't be concerned about the housing market now and what's going to happen in the future. So listen to this very closely because I'm going to tell you this is nothing like last time. And I'm going to explain 6 simple ways and explain everything. Well, not really everything, but to a certain understanding. All right, so last March, many involved in the residential housing industry feared that the market would crush under, the pressure of a once-in-a-lifetime pandemic. So we already have a year in the pandemic situation known as a COVID-19, right? So instead of this whole pandemic that everybody thought it was going to crash and burn, in this case, real estate had one of the best years ever in real estate. So home sales and sales prices were both substantially over the year before. This means that 2020 was strong. So now, many that now feared the market's exuberance mirrors that of the last housing boom. And as a result, if we were headed to a new, into another crash. This is not true. Let me explain you why this is nothing like 2008 and why you should be like, hey, this is a good time to buy. Let's take advantage of those interest rates. Let's sell our house. Let's downgrade, upgrade, do whatever you want to, right? All right. So let me tell you this. So number 1 is mortgage standards are nothing like they were back then in 2008. So if you look at this, during the housing bubble, it was difficult not to get a mortgage. So that means Joe around the corner, he could have gotten a mortgage. Anybody could have gotten a mortgage. But today is really tough to qualify for a mortgage. So if I'm telling you about this, the Urban Institute released their latest housing credit availability index, this is classified as the HCAI, which measures the percentage of owner-occupied home purchase loans that are likely to default on their mortgage. So that means that is, if they go unpaid for more than 90 days past their due date. So, and a lower HCAI indicates that lenders are unwilling to tolerate defaults on their mortgages and are imposing tighter lending standards, making it harder to get a loan. So a higher HCAI indicates that lenders are willing to tolerate defaults and are taking more risk. So making it easier to get a loan. But that is not the case anymore. So if we are comparing this from 2008 and now, you're crazy. All right. So in this way, the index shows, and I'll show you this index and the graph. The index shows that lenders were comfortable taking on higher risk during the housing bubble of 2004-2006. Like I said, Joe from the corner could have gotten a loan too. So it also reveals today that the HCAI is under 5%, which is amazing. And that means it's been the lowest it's been since the introduction of the index. So I'm going to tell you what this report says. So significant space remains to safely expand the credit box. If the current default risk was double across all channels, risk would still be well within the pre-crisis standard of 12.5% from 2001 to 2003 for the whole mortgage market. So if we talk about and look at between 1999 to 2020, I'm going to show you how this index is actually changing here. So default risk in mortgage market. You see that? The product and borrower risk. You see how it goes low? 2020. I'm telling you over and over again, this is nothing like last time. Nothing like last time. So number 2, why are prices aren't soaring out of control? So you think, okay, so appreciation. That means, yes, we are in the right way. I mean, houses are appreciating at its, I'll tell you this, what's going on. So below the graph, I'm going to show you this other graph. This is number 2, keeping this in mind. Below is the graph showing annual home appreciation over the past 4 years. compared to the 4 years leading up to the height of the housing bubble. So through the price appreciation was quite strong last year, is nowhere near the rise prices that preceded the crash. So I'm going to tell you what happened. Annual home appreciation. I'm going to show you this another one here. This is 2002 to 2005. Look at this. 2017 to 2020. What is that telling you? I'm giving you guys the answers here. Do not fear. We're not going into it. The market's not going to crash. Okay, so there's a stark difference between these two periods of time. Normal appreciation is 3.8%. So while current appreciation is higher than the historic norm, it's certainly not accelerating out of control as it did in the early 2000s. So again, this is nothing like last time. So it is not going to crash. Believe me, I'm giving you guys accurate information. Just comment below if you guys have any questions, any concerns. I would love to discuss this with you guys. Number 3, we don't have a surplus of homes on the market. We have a shortage. Supply and demand. You got more supply? Wait, no. Supply, demand. This is how it is. Statistics 101. And I repeat this almost in all my videos. So, all right. So in a regular market, the real estate inventory, if we were to have, needed to sustain in a normal real estate market is 6 months. Right now, we don't even have inventory for 21 days. I mean, if we compare from last year and this year, it was 43 days on the market. Now we have 21 days. That's not good for, that's why there's a huge demand on this. And let me explain this to you. The month supply of inventory needed to sustain a normal real estate market is approximately 6 months. We don't even have that, not even close. I'll get you those numbers. So anything more than that is overabundance and it causes prices to depreciate. So this is what happened in 2008. That's why we had too much inventory, and that's why houses were starting to depreciate. So anything less than that is a shortage and will lead to continued appreciation. This is why your guys' houses are appreciating more and more. So anything, so as the next graph shows, I'm going to show you this. So as the next graph shows, there were too many homes for sale in 2007. That's why the houses were depreciating. Supply and demand. The more supply, the less demand, and that causes prices to go down. And that causes prices to tumble. This is like how I explained this to you guys. So today, there's a shortage of inventory, which is causing an acceleration in home values. Do not panic. You guys are good, especially when they evaluate your houses, as long as it appreciates. So I'm going to show you this between 2004 and 2007, and then 2017 and 2020. So, all right. So see, 2004, 2007, that's how the existing single-family homes for sale. And look at this. 2017, 18, 19, 20. That is the shortage. So, okay. So, again, this is nothing like last time. So, number 4, new construction isn't making up the difference in inventory needed. They're not building fast enough. We don't have enough inventory. So, this is what I'm telling you. This is nothing like last time. Believe me. This is accurate information. This is, gotta see this. Okay, so some may think new construction is filling the void. However, if we compare today to right before the housing crash, we can see an overabundance of newly built homes was a major challenge then, but it isn't now. So let me say single family housing units completed over the 4 consecutive days. I'll show you this. All right. So this is basically how the housing houses. So 1970, look at that. They were building houses constantly. Look at that. This is 13 straight years below 40 years average. they're not keeping up. And this is, you can see from 2010 to 2020, you can see how much annual average units were completed. And some of these builders, I'm talking here about in the state of Georgia, they're only building 10 houses per month because they cannot keep up. And I don't know on that. But this is nothing like last time, 2008. All right, so number 5. And this is going to be very, very interesting for you guys. So houses aren't becoming too expensive to buy. And why? Be like, no, that's not true. All right, if we compare this to last time, 2000. All right, so there's the affordability formula. There's 3 things that you have to take into consideration. All right, so the price of the home, the wages earned by the purchaser, that means you, and the mortgage rate availability. And this is follow this the next time that I'm going to tell you about this. So 15 years ago, prices were much higher. This means, wages were low and interest rates were over 6%. Can you imagine that? Back then and now, what is this telling you? You can afford a house. You can afford much more now than you could have afforded 15 years ago. So today prices are still high. Wages, however, have increased and the mortgage rate is about 3%. That means the average homeowner pays less of their monthly income towards a mortgage payment than they did back then. I'm telling you, don't panic. Take that fear away from your head. Okay, so I'm going to show you this chart again, showing you the difference about, the percentage of the medium income needed to purchase the median home price. So take a look. 21.2%, 25.4%, and 14.9% is today's market. So tell me what you guys think. I want to hear your comments on this. So let me tell you about this. So as Mark Fleming, chief economist of First Americans, explains, low mortgage interest rates and rising incomes correspond with higher house prices, as homeowners can afford to borrow and buy more. If housing is appropriately valued, house buying power should equal or outpace the median sales price of a home. Ta-da! Okay, so looking back at the bubble years, house prices exceeded house buying power in 2006. But today, house buying power is nearly twice as high as the median sales price nationally. Again, this is nothing like last time. This is like the 5th time. All right, so I'm going to tell you the 6th one, and I hope you understand. And please comment below and ask me any questions. Share this video because, you need to be educated and you need to educate your friends, your families, and everybody else on this. All right. So people are equity rich. What does this mean? They're not tapped out. So what happened was, and I'm going to tell you this. So in the run up to the housing bubble, homeowners were using their homes as a personal ATM. That's not good. So as a personal ATM machine, all right, I'm building equity. Woohoo! Let's take more money. Let's take money. Yay! No, you don't want to do that. All right, this was back in the bubble. Now, many people immediately withdrew their equity once it built up, and they learned their lesson in the process. So prices have risen nicely over the last few years, leading to over 50% of the homes in the country having greater than 50% equity. So, and owners have not been tapping into it like last time, which is amazing. And this is why we're where we're at today. And this is a good thing. So listen to the next thing. And homeowners have not been tapping into it like last time. So here's a table comparing the equity withdrawal over the last 3 years compared to 2005, 2006, and 2007. Homeowners have cashed out almost $500 billion less than before. So the total equity cashed out. And I'm going to tell you then and now. All right, so you're going to go ahead and see this now. All right, so you see then? 2005, 2006, 2007, total of $824 billion this year. Now, 2008, 2019, and 2020, $348 billion. So we're looking at people are basically averaging between $75,000 and $190,000 in equity. You're sitting in money here. So let me explain this to you. So during the crash, home values began to fall and sellers found themselves in a negative equity situation. So if you're taking money, it's like you're going to be in the negative. This is why, I'm going to explain to you what that means. Where the amount of the mortgage they owed was greater than the value of their home. So some decided to walk away from their properties, from their homes, and that led to a wave of distressed properties, listings, foreclosures, and short sales, which sold at a huge discount, though lowering the value of homes in the area, with an average equity now standing at, with an average home equity now standing at over $190,000. This won't happen today because you know what? If you sell your house, then you get some equity. So I'm telling you this, look, if you're concerned that we're making the same mistakes as last time and that we're led into a housing crash, nah. So I'm telling you, take a look at this video, to help you alleviate your fears. Take that out of your mind. We're not going to head into a crash. So please feel free to share this, comment below, share this with everybody. I want you guys to understand we're not leading into a housing market crash. It's going to be fine. Everybody has equity, like I said, and I'm going to repeat myself. I know this video has been a little bit longer than usual, but you know what? If we compare about this, equity cashed out in the past 3 years, $348 billion. And the standards are harder to get a loan, to get approved. So this is Cindy Presgraves with Cindy's Realty Group, and I hope to hear your comments and share this video. Have a wonderful night.